Hi everyone, welcome. As usual, I'm here to share with you my view of the market for this week, both technically and fundamentally. And as usual, we're going to start reviewing the calendar. I do believe that maybe the most interesting thing to mention for this week is the fact that we are having payrolls on Friday, right? The market has been trading purely on dollar news over the past 3 weeks, ever since Donald Trump won the presidential election, right? I guess that, and of course, minutes from the Federal Reserve pretty much anticipating a rate hike this December. So I do believe that the market will keep on paying a lot of attention to dollar news. Anyway, so far this week, the calendar has been quite light. We didn't have much relevant data. Not really the first line mover ones. We have inflation in Germany during the upcoming hours, and yes, GDP, but I don't expect much from them. Uh, but in Germany, because we already had European inflation figures and there were not a shock, not a surprise, so nothing really uh, is expected from Germany, right? We are not expecting them to jump to the sky and say, okay, we are doing fine. The eurozone it's recovering and inflation is picking up. In fact, the latest data is showing that the euro area is still in trouble and that um, actions from the ECB are doing very little, right? The stimulus program and all we had over the past 2 years is doing little to boost the economic growth. And for the year's GDP, we are going to get in a couple of hours. The fact is that the second reading, right? It's not the advance, it's quarterly reading, but we had it monthly basis released with three revisions, right? We had the advanced one in October, which came came in at here it is 2.9%, really a surprise. But this time, this is a review of that number, and we're expecting a slight uptick to 3.0%. Usually, not a big mover, right? Unless we have a huge deviation from the original number, we are not going to see much action today. And of course, the final revision that we will get in December will probably be a bit more interesting because it will be the final number, right? I was watching also that we have a couple of Fed members speaking later today, but seriously, with all the comments we have lately and the pump minutes, as I was saying, the market has pretty much priced in 99% chances of a rate hike in December, right? And I'm not saying 100 because in the Forex market you can't take nothing for granted. But well, it's what the Fed is, the message the Fed is offering, and I don't expect them to offer nothing different in these different events. Okay, on Wednesday, I do believe that one of the most relevant things we are having, and will probably affect much the forex market, will be the OPEC meeting. Right, crude oil worldwide producers have been ever since late September, right, talking about the possibility of an output cut deal, right? Uh, they draw a preliminary agreement in September, and ever since they have been negotiating to seal that deal in their next official meeting, which is this one that's tomorrow, taking place tomorrow. The fact is that there are several non-OPEC members that OPEC oil producers, sorry, that are willing to participate in this deal, right, including Russia. But the fact is that there is still no consensus between among the OPEC members, right? Iran and Iraq are unwilling to cut production much. They can cap but not cut, and they're still batting on how much oil they can produce or offer to the market daily basis. There was a huge meeting yesterday, and they did not come to an agreement. So the market is actually looking for a disappointment this Wednesday, right? And the reaction of oil prices could affect the greenback and could affect the forex market on dollar strength or weakness, right? Yeah, a real surprise, a real market mover will be if they come to an agreement that really cuts oil production, something that has 0.001% chances, something like that. Okay, really, really low chances. So that will be a huge surprise, and therefore put the greenback under serious pressure, okay, across the world. We have a November preliminary inflation in the euro area, and Draghi is speaking also tomorrow, but I do believe that the ADP will be the next focus of attention alongside with personal consumption expenditures. You know, the ADP tends to anticipate whatever the payroll may offer on Friday, and personal spending and consumption are figures that somehow are telling us whether inflation in the US is really advancing or not, right? If we have more spending and higher incomes, the people is more willing to, higher incomes show that the people is more willing to spend. More spending means more consumption, and that will, it's the base of inflation, right? I know the US inflation is pretty much okay, but we really need the US really needs inflation to pick up a bit more strongly and not just on upcoming Trump policies hopes, you know. Anyway, the Fed beige book, sorry, used to be relevant, right? Because it was a measure of the economic health of the different regions in among the United States. To be honest, the report has lost its shine. Attention is 100% in the Fed and whatever they said about employment and inflation. I would be paying attention on Thursday to all the manufacturing and services PMIs that are going to be released all through the world. Chinese data, of course, will probably affect the more commodity related currencies such as the Aussie or the New Zealand dollar. And better than expected figures in here should probably boost market sentiment into positive territory. Market has started the week with a sore tone, right? Stocks retreating, not really serious in America, a bit more worrisome in Europe. I guess there's a lot to talk about in there, right? US stocks are at record highs, and this latest fall we are seeing yesterday and the probable fall we would see today seems mostly a correction or a wait and see until we have a new catalyst. But in Europe, things are a bit more different because I believe there's a lot of uncertainty of the health of the banking system in all Europe. You know, Italy is having a referendum this weekend over whether to maintain the powers of the Senate or cut them. That puts at risk the continuation of Matteo Renzi as prime minister, and if he resigns, the market fears that the fragile banking system in Europe will finally, in Italy, sorry, not in Europe, will finally collapse, and that indeed will affect all the European indexes and, of course, the euro. Anyway, uncertainty, fears, Brexit, Greece, Italy now are all factors, political factors that are weighing on European stocks and which can affect also the common currency and keep it under pressure. In the calendar, there's, of course, the manufacturing PMIs for the region. The fact is that lately the numbers have been quite strong. Uh, Growth has been strong, firm in the euro area and the main key countries. So we're not expecting a negative surprises in here. But I doubt that positive numbers can really suggest the bottom has taken place in the euro. You know, I believe that the euro is still weak and we may see some further declines, particularly if we get mild disappointing figures in Europe and a strong payroll on Friday. I do believe that that could be the key. Anyway, the US will also release its PMI figures on Thursday. The market will pay more attention to the local one rather than the market one. But overall, the numbers are expected to remain within solid growth region. Okay, and of course, Friday payrolls. Uh, that's what probably would take center stage. Most important thing I can say about this is that remember the market used to watch the unemployment rate and the headline. The headline is expected to show some interesting growth in employment. Unemployment rate to remain steady at 4.9. Even if it tick ups to 5.0, it's really not an issue because it's within the Fed's target, right, for unemployment. And I can remember that last month the surprise came from wage that rose by more than expected annually and monthly. So keep an eye on those numbers because whatever the headline is, unless it's a shocking to 50 or to 40, something like that, if this one comes in line with expectation and previous, then attention would flip, sorry, to our wage. Okay, and if we have an uptick in there, the market will keep on pricing in the possibility of a Fed rate hike next December, and will probably keep on buying the greenback in spite latest extreme over both readings we are seeing in the American currency. Okay. Anyway, sharing my charts with you. Here is the euro dollar, and as you can see, the pair has found some sort of base to its latest plumb. It's clearly in a consolidated phase. I know that almost 113 we test post US election. It's a bit of a fake number because it was a short lived move and a reaction that was quickly reversed. But anyway, what I'm seeing in this particular chart is that the price has been unable to correct not even 23.6% of this latest daily fall, which stands around 700, right? So for me, it's sort of like a short-term line in the sun. Is if a pair can recover above this level, there's a good probability, sorry, that the upward control correction will continue and will extend up to the 840 region. We have the 38.2% at 815, and that sorry, between 800 and 814, we have plenty of relevant high and lows. So that is the probable bullish target and will probably uh, be corrective, right? And the pair really needs to move far beyond this level to turn really bullish, something I can't see at this point. Anyway, I will change a bit to monthly charts. I know it's a bit disturbing, but in December last year, we have a monthly low of right 505. In November, the low was at high 520, right? Then this month, we had a 517 according to my charts, which means that that 500 region is critical and the support to break to talk about bearish extension. But we also have, and for me it's quite relevant, 2015 low at 461. So for me, the supports from these levels, right? Not meaning in the short term, maybe 560 is the first, but the relevant one, the really relevant one is 500, followed by 416. If the pair loses that 416, I do see it scope for it to test 1.02 or something like that. Anyway, and the approach to parity will be one step closer. I'm not sure if the pair can lose those 460 pips really fast, or if it cannot, or if the market will probably. We're talking about the longer term. I'm not seeing this happening this week. The most I can see this week is the pair falling down to that 460. But if somehow we close the week around those lows, the risk of a downward extension remains high, and then I would think about probably 200 for December. Okay, maybe the next couple of weeks when we had the Fed. And for the pound, I am following this forward chart, take a look at my moving average at 221. They are horizontal, they are directionless, and the price is moving back and forth around it. If you take a look at your daily chart, not yesterday, but the previous Monday, right, the pair traded between 23.10 and 25.10 at 200 pips. And despite we have a small spike above the high yesterday, the fact is that it has been trading within that range for all past week and what we are having from this one. So that is leaving the pair quite directionless. Okay, it's quite flat. I have this ascendant trend line coming from October 25 low, which is acting as support and suggesting that the downward potential is limited. But I still don't see here much of an upward strength. I do believe that the market is actually waiting for clearer clues about Brexit, not about the Bank of England, but the Brexit itself and whether we're going to have a trigger or not, if we're going to have a soft or hard Brexit, and so on. The latest Theresa May, UK Prime Minister, comments were quite conciliatory. Uh, she's softer her tone about the Brexit, but I keep on seeing that the rest of the euro area is not willing to allow that. They want a hard Brexit. They said if you want to go, go. You lose it. It's your loss, not mine. And that will probably weigh on the pound in the longer term. But in the short term, and as long as we remain between that 1 to 23, 25 region, the pair is trendless, right? We have some spikes up to 25.20, 25.30. So I do believe that we need to really break above this level. I don't see that happening today. To talk about an upward extension that could extend up to 25.90 first and above this level towards the highs reached this month in the 26.70 region. Honestly, I don't see the upward potential in here to continue advancing up to 130 or something like that. I do believe that this ongoing bullish tone is pretty much temporal and not nothing, not really a long-term thing. Anyway, supports short-term ones. We have one at 24.10. In fact, the 24.10-20 region is immediate support. 23.70, 80, yes, 70, 80 is the next one. We have plenty of lows plus the trend line there, and below that 123, 123.30 region. Let me show you here the 22, the 23, sorry, 2030 region has been a major resistance all through October, and so far it's been a strong support. So uh, a clear break below 123 is what market needs to turn bearish in the pound. Okay, and when it comes to the dollar Japanese yen, the pair has reached a major bullish target. We have discussed this level. I will change my chart to monthly. I know it's a very long-term charts, but this is the low from 2011, and this is the high from 2015, right? The latest plummet to 100 and below, right? Found support around the 50% retracement of that level. And once the pair recover above the 38.2, we discuss the possibility of an upward correction up to 14, or an upward continuation up to 14, which is the 23.6 retracement of that yearly run. Okay, and there we are. We reach it. Well, still 10 pips shy below it, and then we have this downward correction. But anyway, if you take a look at this daily chart, the overall bullish tone persists, right? The pair is developing above its moving average. The 100 moving average is getting closer to the 201. It would be great if it cuts above it and the price breaks above this level to confirm an upward extension, probably towards the 120 region in the longer term. But anyway, there's a long run until there. Still, the pair can retest these highs if we have some positive comments from Fed officials, some positive US data, and particularly a really, really strong payroll with strong wage and how does it? Most of the components, not only the headline, but also the components of a payroll being extremely positive, right? That what is what it takes for the pair to go back to that highs and probably break above that 14 region. Anyway, in the short term, this latest pullback seems corrective. Uh, I was thinking that even despite stocks are not doing so well this week, are a bit of a risk aversion and such, the downward potential was limited and the period starting to recover around. So anyway, my first resistance for the upcoming days it's 1310, right around Friday's close. Above that level, I would expect the pair to advance up to this region. Honestly, I'm not expecting it to break higher ahead of payrolls, but it can. And in that case, there's not much in the way up to 115. Okay. And the low we have on Monday was 111.35, if I'm not wrong. Yeah. So, and we have some former highs in that region. So that is for me the support to watch. Below that level, the pair will lose. It's lost. Sorry, lose its bullish trend and its bullish potential, and probably be setting up for a stronger downward retracements towards 109.50, 70 or so, that region. Okay. The Australian dollar was a bit of a surprise, the behavior these days, because it broke below 74.15, right? And reached the 50% retracement of this early year rally. And all of a sudden, we have this recovery in spite of dollar strength and in spite of a modest, sorry, of the poor tone of stocks we are seeing these days. Uh, in Europe, particularly, not much in the US. But anyway, here we are. We'll recover about 74.15, although I was watching earlier today that the rally is down around the very bearish 20 simple moving average in the daily, and that the price is back retracing toward that 74.15. If we break below this level again and the pair falls probably below 74.20 or so, and we close the day around those levels, the risk will turn sharply lower, and there's a good chance that the pair will retest the 73.30 region. Um, the upward potential seems quite limited, but I really was not expecting the pair to post this sharp recovery. It was also backed by base metals, iron ore, copper, are rising really, really sharply these days on the idea that Trump will make great expenditures in infrastructure uh, in the US after he becomes the official president. So that's triggering demand for such metals, and that's backing the OC. But still, the upward potential, despite the recovery and despite the periods above 74.15, seems quite limited. As I said, that's my first support. 74.20 is the next one. If we lost that level, the pair can go down to 73.60, and that's the next level en road, sorry, to the 73 lows we tested earlier this month. Uh, the 75 level is the one that is attracting sellers these days, but we have some relevant lows a bit above that level. So my take is that only if we advance beyond 75.40, the pair can recover farther up to the 76 price zone, where the pair has also made a static resistance zone. Okay, and when it comes to gold, the commodity has been consolidating. I do believe that the market has pretty much fully priced in here the fact that the Fed will rise rates, which does not mean that it can't fall further. Uh, uh, I guess we discussed this plenty of times. Production cost is 1100, 1150. So The decline is obviously decelerating as the metal approaches to that region, but that does not mean it can go down to 1070, right? Sorry, the lows we see earlier this year. Still looking bearish for me, but with the downward strength limited, right? And overall waiting for more close. This week we had an attempt to recover above 1200 and so far failed. I do believe that above that level the commodity can go up to 1210. Honestly, the highest I can see it these days is 1233, which is the 38.2 retracement of the latest slide, and where we have several relevant highs. Okay, and if somehow the price breaks below 1170, which is the low achieved last week, uh, then there's a scope for a decline, or sorry, to 1115. Okay, sorry for that. I have to think about the numbers. Anyway, and when it comes to oil, well, as we talked earlier today, it's all about the OPEC and how the OPEC will act uh, tomorrow. Okay, waiting for tomorrow's outcome, which will probably be a disappointment, and the market is already pricing that in. Take a look at 45.10, 45.10 region. If the price breaks below these levels, there's a good chance will probably go back to the lower end of its long-term range around 42, 42.15. Okay, and seriously doubting that we're going to see a 25 again in the oil barrel. 40 probably 42.50. That's uh, the price zone I'm expecting the commodity to target, and not far below. And if somehow we come to a deal, the commodity can go up to the 48.60 region, which for me is a major resistance, and above this level 52, which is the upper end of a recent range. Okay, but keep in mind that in between 40 52, that's the range, the comfort zone goal. Sorry, oil has said lately, and I do believe that it's worth trading those extremes uh, uh, in a wider perspective. Okay. Anyway, my time is up. Uh, so uh, I'm saying goodbye and see you in a few minutes. Okay, when a couple of hours, I believe, I'm going to cover live the GDP release with your high alarm, and of course, always with Mauricio Carricio. Thank you so much for being here, and see you later. Okay, okay, bye bye.